Hello and welcome. Today we're unpacking a story that sent a ripple of concern through the financial markets. We're talking about Walmart, the retail behemoth, a company whose performance is often seen as a barometer for the health of the American consumer. Recently, Walmart released its latest earnings report and investors were watching closely. But the reaction was not what many expected. Despite posting some solid numbers, Walmart's stock took a significant tumble. The big question on everyone's mind is why. If the company is still making sales, why did Wall Street hit the panic button? The answer isn't in what Walmart has already done, but in what it says is coming next. Let's first look at the headline numbers from the report, because on the surface, they looked pretty good. The company's revenue actually beat analysts' expectations. U.S. comparable sales, the metric that looks at sales in stores open for at least a year, were also up. This tells us that people are still walking through Walmart's doors, and they are still spending money. In fact, they're spending more money than they were this time last year. So with those positive signals, you would assume the stock would be soaring. But that's where the story takes a sharp turn. The real reason for the stock's decline lies hidden deeper in the report, in a section, Wall Street obsesses over the company's guidance. Guidance is essentially the company's forecast for its future financial performance. It's management telling investors this is what we expect to earn in the coming months. And Walmart's forecast was grim. The company drastically cut its profit outlook for the rest of the year. They announced that they expect their earnings per share to fall by a much larger percentage than they had previously warned. This was the red flag that sent investors running for the exits. The strong sales of the past didn't matter as much as the warning of weak profits in the future. So this brings us to the core of the issue. Why is Walmart suddenly so pessimistic about its future profits? The answer boils down to two powerful forces: inflation and a major shift in consumer behavior. First, let's talk about inflation. It's the story of the year, and it's hitting everyone's wallet. Prices for essentials like gasoline and food are soaring. When families have to spend more money just to fill up their cars and put food on the table, they have less money left over for everything else. This is precisely what Walmart is seeing in its stores. Consumers are now prioritizing low-margin necessities over higher-margin discretionary items. Think about it this way. Walmart makes a very small profit on a gallon of milk or a loaf of bread. But it makes a much healthier profit on a new television, a set of patio furniture, or a new line of clothing. Right now, customers are filling their carts with groceries and bypassing the electronics and apparel aisles. So while total sales dollars might be going up because food is more expensive, the profitability of those sales is going down significantly. This leads directly to the second major problem: inventory. Just a few months ago, consumer demand for general merchandise was incredibly high. Retailers like Walmart ordered massive amounts of goods to meet that demand. They stocked their warehouses with electronics, home goods, and apparel, expecting the shopping spree to continue. But now that consumer spending has shifted so abruptly towards necessities, Walmart is left sitting on a mountain of unsold discretionary items. They have an inventory glut. And what happens when a store has too much of something that isn't selling? They have to put it on sale. Walmart announced it would need to implement aggressive markdowns to clear out this excess inventory. They have to make space for crucial upcoming seasons like back to school and the holidays. While these sales might be good for shoppers looking for a deal, they are terrible for Walmart's bottom line. Every dollar they discount is a dollar taken directly from their potential profit. Finally, it's important to understand that this is more than just a Walmart story. It's a warning signal for the entire U.S. economy. Because of its massive scale and customer base, Walmart provides a unique real-time snapshot of the American consumer. When Walmart's customers pull back on spending, it's a strong indication that households across the country are feeling financial pressure. The news from Walmart's report immediately dragged down the stocks of other major retailers. Investors are now worried that companies like Target, Amazon, and Best Buy will soon report the same combination of slowing demand for general goods and a costly inventory problem. So to summarize, Walmart's stock didn't fall because of poor past performance. It fell because the company painted a bleak picture of the future, where high inflation forces customers to buy less profitable items, and where the company must slash prices to get rid of merchandise people no longer want. It's a clear sign that the economic environment is becoming much more challenging, and investors are taking notice.